The macroeconomic picture continues to change quickly, and second-guessing events and policy developments in Washington, Jerusalem, Tehran, Kiev, Moscow, Brussels, and more, not forgetting London, is hard work indeed, and interpreting what they may mean for the markets all the more so. This is why many investors block out the macro altogether and just focus on company fundamentals. The coming week features a select list of scheduled company updates here in the UK, though do keep an eye out for unscheduled ones both here and in the US. As we draw nearer to the second quarter results season, boardrooms will start to get a feel for how firms are performing relative to expectations for the second quarter and also for the rest of the year. Either way, this week's roster includes full year or interim figures or trading statements from the following, although the dates could yet be subject to change: for Expo on Monday the 7th of July, Jet2, Gym Group and Zigup on the 9th, and DCC on the 10th. But three other firms may make more of a fuss in the coming week, and they're Unite on the 8th, Vistry on the 10th, and PageGroup on the 11th. Unite is a real estate investment trust, or REIT, and it specialises in student accommodation. The company is due to release a second quarter update ahead of the actual interims that are due on the 29th of July. The shares are trading actually in a 5-year lows, thanks to 2024's abolition of multiple dwellings relief on stamp duty land tax, concerns that government energy efficiency regulations may oblige Unite to retrofit some of its properties and thus spend more, and also longer-term concerns that growth in student numbers is slowing, especially for those who hail from overseas. Shareholders and analysts will therefore look for any comments on the guidance for this year already given by Chief Executive Joe Lister. Unite has thus far pointed to 97 to 90% to 98% occupancy for the full year, with rental growth of 4 to 5% for the student year of 25-26, and adjusted earnings per share growth of 2 to 4% to around 48 pence a share compared to last year's 46.6p. Analysts and investors will also look for an update on the progress on the £450 million raised last July. Attention will focus on new developments and approvals for that money. Unite already runs over 150 properties across 23 cities in Wales, Scotland and England. And any new developments will ultimately feed into rental growth and therefore changes in the valuation of the total asset base across the wholly owned portfolio, the United Kingdom Student Accommodation USAF Specialist Fund, and the LSAV joint venture with the Government of Singapore, which Unite manages. Net asset value per share was 982 pence at the end of 2024, so watch out for any update there, especially as Unite's trade now at a mid-teens percentage discount to NAV, even though a recent disposal of 9 properties came in just 1% below book value. Analysts and investors will also look for an update on the £700 million plus cash and stock bid launched for fellow REIT Empiric Student Property back in June. House builder Vistry is another company whose share price is mired near 5-year lows, and that's largely down to a very difficult 2024. The company coughed up 3 profit warnings in quick succession, with the result that annual pre-tax profits ultimately fell by 2/3 on a stated basis, net debt more than doubled, and there was no dividend, although the company did buy back £173 million worth of shares last year. This trading update for the first 6 months of 2025 precedes the actual first half figures that are due in September. Analysts will look to Chief Executive Greg Fitzgerald for a reassurance that last year's problems were limited to just 2 of the 4 regional operations in the south, and that those problems are now in hand after a major reorganisation of management there. Vistry is a combination of Bovis, Linden Homes, Galliford Try Partnerships and Countryside, and its model differs from that of many of the other listed builders because of its focus on partnerships and mixed tenure homes. Affordable housing is a key focus, and this is a big priority for the Labour government too. The statement, well, it's not likely to be too detailed, but watch out for comments from Mr. Fitzgerald on forward order book, 4.4 billion at the last count, sales rate per site per week, which was 0.59 in the first quarter, input cost inflation expected thus far to run in the low single-digit percentage range, net debt, which management looking to cut by reducing inventory of unsold dwellings, and the expected second half uptick in margins and second half weighting to full year profits. The current analyst consensus is looking for adjusted pre-tax profit of £270 million for the whole year against £264 million last year, and that equates to £243 million against £109 million on a stated basis. And finally, to recruitment giant Page, whose shares traded at their lowest mark since 2009 in the aftermath of the great financial crisis. thanks to worries about the UK and global economy, and more immediately, a profit warning from sector peer Hayes in June. The key figure to watch here will be the like-for-like change in gross profit. This was down 9% year-on-year in the first quarter, the 9th consecutive drop. Hayes warned of no improvement in the second quarter, though it does have a different client and geographic mix. Analysts and investors will look to the regional trends at PageGroup too. America's returned to growth in the first quarter on a constant currency basis, but the UK, Asia, and Europe, Middle East, Africa regions were all down by between 11 and 13% year-on-year. Thank you for watching. Hope that you and your families are all in good health and good spirits, and I look forward to seeing you again next time.